Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back to the channel. Today we're breaking down why AI companies that violate intellectual property rights are a risky bet for your 2025 investment portfolio. If you're investing in tech or curious about where AI is really headed, this video is for you. Investing in the tech sector requires a keen eye for sustainable growth. When it comes to artificial intelligence, that growth relies on intellectual property, or IP. Think of IP as the legal fence around a company's ideas, including copyrights for creative work, trademarks for brand names, and trade secrets for private code. In the AI world, these rights determine who owns the data used to train a model and who owns the content the model creates. Many early startups took shortcuts by scraping the web without asking, but the tide is turning. As we move through 2025, the honeymoon phase for move fast and break things is over. Lawsuits are stacking up, licensing rules are tightening, and big buyers are finally asking for receipts. If a company's foundation is built on stolen property, your investment could vanish overnight. Why AI companies that violate IP rights are a bad investment in 2025. Investing is about assessing risk versus reward. In 2025, the risk of backing an AI firm with shaky IP practices is at an all-time high. It is not just a legal headache. It is a structural business failure. Imagine an AI company that builds a tool to generate marketing images by scraping millions of photos from professional photographers without a license. Or perhaps they have trained a coding assistant by copying a rival's proprietary software. These are not clever hacks. They're liabilities. When a company gets caught using unlicensed data, the financial fallout is swift. Legal fees alone can drain a startup's cash reserves. If a court finds copyright infringement, damages can reach millions of dollars. Worse, judges can issue injunctions, forcing the company to pull its product from the market immediately. In some cases, the company may be ordered to delete its entire model and start over from scratch. This process, known as forced retraining, is a death sentence for most startups. The market reality of 2025 has changed. Large enterprise customers now demand proof of rights before signing contracts. They do not want to risk lawsuits because an AI tool generated copyrighted material. Insurance companies and banks are also tightening requirements, often refusing coverage or financing to firms without clean data sources. Even if a company survives, unclear IP rights can destroy acquisition opportunities. No major tech firm wants to buy a lawsuit disguised as a startup. The 2025 risk stack lawsuits shut down orders and forced retraining. Problems often begin with a single claim from a creator or publisher. This triggers discovery, where lawyers examine training logs and data sources. If violations appear likely, courts may order a product pause, killing momentum and driving customers away. The final blow is often an order to remove or forget the data. Cleaning a model of tainted information is rarely possible. Most companies must discard the model entirely and retrain from scratch. The cost and time involved are enough to shut down most startups. Hidden costs: investors miss customer losses, platform bans, and harder fundraising. Beyond legal battles, practical problems multiply. App stores and cloud platforms increasingly ban products tied to IP violations. When a tool is removed from an API or marketplace, revenue can stop instantly. Venture capital firms are also more cautious. They demand proof of data provenance and stronger warranties. Without clear documentation, raising capital becomes far more difficult. That's the first part of why ignoring IP rights can destroy an AI company and your investment. In the next video, we'll cover the biggest red flags to watch out for and what smart investors should look for instead. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.